How to choose between bank loans and private investors. Welcome back to the channel. If you're starting a business, scaling an existing one, or simply need funding to get your idea off the ground, you've probably asked yourself this major question. Should I go with a bank loan or look for a private investor? Both can fund your dream, but they come with very different expectations, benefits, and risks. In this video, we're going to help you decide by breaking down what each option really means, their pros and cons, and how to choose the best one for your situation. Let's get right into it. Number 1. What is a bank loan? A bank loan is when a financial institution lends you a specific amount of money that you agree to repay over a set period of time with interest. This means that no matter how your business performs, you are responsible for paying back that money on time. The advantage here is that you retain full ownership of your business. You don't have to share profits or give anyone a say in your decisions. The bank gives you the money, and in return, you make regular monthly payments until it's all paid off, plus interest. Bank loans come in different types. Some are short-term loans meant for quick funding. Others are long-term loans for bigger investments like buying equipment, launching a store, or expanding operations. There are even lines of credit, where you borrow only what you need and repay it as you go. But there's a catch. To qualify, banks usually require strong credit history, proof of revenue, and sometimes collateral like a car, house, or business assets. Number 2. What is a private investor? A private investor is someone or a group who provides funding for your business in exchange for something other than loan repayment. Most times, they want ownership in your business, a share of the profits, or some other form of return on their investment. This means they become a part of your business journey. They're not just giving you money, they're often offering guidance, connections, and strategic advice. You've probably heard of angel investors or venture capitalists. These are examples of private investors, but they can also be friends, family members, or successful business people who believe in your vision. Unlike bank loans, you don't have to repay the money month by month, but you also don't own your business 100% anymore. They now have a stake, and that means you may need to consult them when making major decisions. Number 3. The pros and cons of bank loans. Let's start with the benefits. When you take a loan from a bank, you keep full control of your business. No one tells you how to run it. Your relationship with the bank is strictly financial. As long as you repay the loan as agreed, they don't get involved in your operations. Loans also help you build business credit, which can make it easier to secure larger funding later on. Now, the downsides. Bank loans must be repaid whether your business succeeds or fails. Even during slow months, you're still expected to make those payments. If you default, it could damage your credit score, or worse, result in legal action or asset seizure if you use collateral. Another challenge is that the approval process can be strict and slow. If you don't have strong credit or a proven track record, you might get denied. Number 4. The pros and cons of private investors. Private investors bring more than just money. They often come with experience, industry insight, and valuable contacts that can help you grow faster. You won't have monthly repayments hanging over your head, which gives you more breathing room to focus on growth. And since their success is tied to yours, they're often motivated to help you win, but giving up equity means you're no longer the sole decision maker. You'll likely have to share control, especially if the investor has a significant stake in your business. Some entrepreneurs find this frustrating, especially if their vision clashes with that of the investor. Also, many investors expect a return on their investment within 3 to 7 years. This can create pressure to scale quickly or sell your business sooner than you'd planned. Number 5. How to choose. Key questions to ask yourself. Choosing between a bank loan and a private investor isn't just about numbers. It's about what kind of entrepreneur you are and what kind of business you're building. Here are a few key questions to help you decide. First, do you want to maintain 100% control over your business? If your answer is yes, then a bank loan may be the better fit. You'll have to repay it with interest, but your business remains fully yours. Second, Do you have a good credit history or collateral to qualify for a loan? If you're just starting out and don't have solid financial records, a private investor might be more accessible. Third, how fast do you need the money? Bank loans can take weeks or even months to be approved. Investors, especially angels or family investors, can move much faster if they believe in your idea. Fourth, are you looking for more than money, such as mentorship or networking opportunities? Private investors often offer those added benefits. While banks don single quotes T.Fifth, are you building a lifestyle business or a high-growth startup? If you want to grow slowly and maintain personal control, a loan is probably your best bet. If you're trying to scale fast and go big, you may need the deeper pockets and resources of an investor. Number 6. Real-life example. Let's look at a few examples to bring this home. If you run a small service-based business like a salon, bakery, or freelance agency, a bank loan may be all you need. You likely have consistent income and want to grow steadily without giving away ownership. But if you're building a tech startup, app, or a new platform that needs large capital to build and launch, and you're aiming to disrupt an industry, then private investors are often the better option. Similarly, an e-commerce business that wants to quickly expand to multiple countries might benefit from investor funding, while a local retail shop might just need a bank loan for inventory and rent. Number 7. Final advice before you decide for making any decision. Sit down and assess your financial situation. Create a business plan. Know your numbers. If you're considering a loan, shop around. Compare interest rates, repayment terms, and application requirements from different banks or credit unions. If you're thinking about investors, prepare a solid pitch deck. Know how much of your business you're willing to give up, and be selective. You want someone whose values align with yours, not just anyone with money. Remember, your funding choice will shape how your business operates and grows. So don't rush the decision. So, bank loan or private investor, which is right for you? There's no one-size-fits-all answer, but now you have the tools to make an informed decision. If you found this video helpful, hit the like button, subscribe for more business tips, and drop a comment below sharing your funding challenges. I'd love to help. Thanks for watching, and I'll see you in the next video.